Murali M Natrajan, the MD and CEO of the bank, joins us from the sidelines of the Ambit conference in London. Good afternoon, sir, and thanks so much for joining in. Well, it's been a while since your numbers came out, but we didn't quite get chatting with you at that point. Let me first start with, the loans against property, because that's where, the street is a bit concerned. It constitutes about 25 to 30% of your overall loan portfolio. There is talk about excessive competition, which is driving down yields, overvaluation of assets. How are you reading the LAP book or loans against property? And are there any concerns for DCB Bank?
So about 43% of our loan book is mortgages. And out of that 43%, about 70 odd percent would be loan against property. We started this business in DCB Bank about, I think, in 2009 or early 2010. What we are doing is that we are focusing on small ticket. Our average ticket size is ranging from somewhere like 30 to 40 lakh rupees. We are working on efficiency of operations, expanding geography. Almost all the 200 odd branches are selling all kinds of products and definitely loan against property. Where we are seeing some pressure, no, I'm not talking about our portfolio, where we are seeing some pressure in the market perhaps developing is that when any of the financiers are giving high ticket loans, say for example above 3 crores or above 5 crores, and also stretch some LTVs. And on top of it, if the customer is taking some more unsecured loans from other financiers, then we do see some pressure building in terms of the repayment capacity of the customer. As far as our portfolio is concerned, for the last few years, we have always kept our ticket size less than 3 crores. The maximum ticket size is 3 crores. Very few loans we book above 3 crores. So to that extent, we don't see pressure on our portfolio. Of course, we have very sophisticated analytics, which helps us to see if there is any issues developing in any segment and then take quick action to correct it. Having said all this, competition has intensified in loan against property because they find for the self-employed segment. And as you know, DCB Bank is focused only on self-employed segment. In the self-employed segment, banks and financiers have figured out that lending a loan against property product is a much better way to grow their portfolio.
Right. So could you tell us, sir, since a significant part of your book, overall book, is loans against property, meaningful, not majority, but meaningful portion of your book is that segment. What are all these loans that you've made rated by an agency or two? I mean, are these all covered for credit worthiness? Because,
no.
Yeah, go on. These are very small loans.
These are loans at $100,000 and small loans. I mean, like 30 lakh, 40 lakh. These are not rated, but we have our own internal rating system to rate these loans, and we use data analytics to look at multivariate analysis in terms of the delinquency, that is loan to value ratio versus pricing, loan to value ratio and geography, different customer segments, loan to value ratio, size of the ticket size. So multivariate analysis is done to see if there is any problem with the portfolio. Also, we look at vintage. For example, loans booked in January 2016, how are they performing versus loans booked in February, March, like that, if there is any issue that is developing because of the time period of loans. So those are the ways in which we look at the portfolio. There is no rating on these portfolios.
Sir, just to assess the competitive intensity in this particular segment, if you could tell us what the yields on your LAP book are currently and what would it be, say, a year ago, just to see if the yields have indeed come down on account of competitive pressures, and what would be your outlook on yields going forward?
So can you just repeat the question, because I'm not very clear what is your question.
So I just wanted to know if on account of competitive pressures, we've seen the yields or the rate that you give on your LAP book come down. And if yes, if you could quantify. And is that going to put pressure on your net interest margins going forward?
Yeah. So as far as net interest margin for the bank is concerned, currently it is at about 3.9, 3.96. We have always maintained that competitive pressure is very high. So our projections for the next 3 years, we have always made it at about 3.7, 3.75% as our NIM. We don't make forecast assuming that NIMs will continue at a higher level forever. As far as NIMs in LAP or any other portfolio for that matter, cost of funds are steadily coming down, and under the MCLR, there is a process by which you have to pass on the reduction to customers. So that is one impact because of which yields are coming down. Competitive pressure is another reason why yields are coming down. Our own analytics sometimes helps us to go back to the customer and offer a lower rate because we find that credit risk to be more acceptable than at the time when we booked. So therefore, we are able to do some repricing based on credit parameters, which is an acceptable practice. So these are the reasons why yields are coming down. Of course, one of the big reasons is definitely competitive pressure.
Got that. So we will see some fundraise from your bank in the near future, the next 6-12 months?
We have approval from the board and shareholders for raising Tier 2 capital. So we are in the process of examining the same. And we hope in the next month or so we will raise some Tier 2 capital. Our capital position is pretty strong. We have not, in the latest published results, we have not considered the current year profits in the capital adequacy. So that will get added at the end of the year. Based on the current projections, if everything goes well, we should be looking at raising some capital in August or September 2017.
How much, sir?
The quantum of that has not been decided, but perhaps if we...
How much do you have approval for, and approximately?
The current rate, which is about, say, No, there is no approval or anything. I'm just saying that our capital projections indicate that somewhere between August to September 2017, we may look to raise Tier 1 capital of about 300 to 400 crores. So that depends on how we perform from now on to next year and what is the growth rate and how is the market and so on.
Right. And how will you raise that? I mean, you'll do what route will you take?
That has not been finalized yet. There are two major routes that we can take or combination of it. One would be QIP, another would be preferred placement. But those details have not been worked out
But
yet.
300 to 400 crores in the next, within the next 2 months or so, could be likely. Thank you very much, sir. Appreciate you.
September.
Next year.
Sorry,
August
17.
August to September 2017. That is what we are saying. Not
Within August to September 2017.
Yeah.
But you also said next 1-2 months we may finalize. You began by saying that, right?
Tier 2 will be within a month.
Okay. Sorry, yes. Tier 2 will be within a month.
Next to 1 to 2 months, we will do Tier 2 capital. Tier 1 capital is August to September.
Got that, sir. Thank you very much. Apologies for that confusion. I think self-created. Appreciate you sharing those details with us.